Wilkie Farr. It's a New York law firm. We are in Paris approximately 60 lawyers. We are an important player in the for capital market transactions and for M&A work, and in particular LBO. Have the pleasure to have some prestigious clients such as those who presented around this table, and I'll have the pleasure to speak to you a bit later.
Good morning, I'm Bertrand Finet, part of CVC in Paris. As you know, CVC is a European LBO firm. We have 10 offices all over Europe, and we have more or less 9 to 10 billion euro under management. We are actually raising a new fund exactly at the same moment as my friend on my left.
Good morning, Michel Price. I'm a partner of PAI. We are a little bit smaller than CVC. We are doing exactly the same business. We have a certain experience of P2P, as I will explain to you later.
Good morning, Emmanuel Garou. I'm the banker working for Morgan Stanley in charge of equity capital market for France and the Benelux region. Our job, as you know, amongst other things in terms of advisory, is to bring issuer to the market in terms of IPOs, and that's what I will talk about later on.
Just a few words as introduction of the P2P market, especially the P2P market in France. It was actually a funny subject because we don't think there is a market for that in Paris, because if you look at what has happened over the last 5 to 6 years, and we had to find to look for example very hard. I mean, there has been more or less 5 to 6 P2P over the last 5 to 6 years in France, so once a year. So it's not a huge market. Why that? I think the first reason is because the market cap of the French stock market compared to the UK one is much smaller. The other reason maybe is the fact that the free float is somewhat limited. And I think the last point, which is a difficulty for all of us, especially in the private equity sector, is the problem of the threshold to get 95%, and we will discuss about that later. And maybe the last point was the difficulties of making decent due diligence in public company. So it was a quick introduction. Over to you, Daniel.
The panel decided that as there is no market, the lawyer should speak. Because everybody knows that the lawyer doesn't need the clients to work. So let's brief. Just what I propose to do in maybe 5 to 10 minutes is to give you an overview of the maybe of the reasons why there is no P2P market in France. However, let's maybe not exaggerate. As Bertrand said, there is at least let's say at least one per year, or a few numbers per year. So four topics. First one being the thresholds in some European countries. This chart shows you three criteria of importance when you think of a P2P. First question, is there a minimum acceptance condition in case of a voluntary offer? Let's assume, which is not usually the case, that we are in a voluntary offer. It's not the most often case, but that can occur. An important question, is there a minimum threshold which, if I do not reach it as the initiator of the offer, where I can renounce to my offer? In other words, I want to get to 95% because I want to delist my company, P2P, the second P being private. I want to delist it, therefore I need, let's say, for example, in France, to reach the threshold of 95%. If I reach, can I say in my offer that if I reach only a threshold of 87, of 75, that I renounce to my offer? So that's really one of the important discussions in a voluntary offer. Nothing is included in the takeover directive. In France, yes, it is permitted, but in practice, the authorities, i.e. the AMF, has only accepted in the past thresholds up to 2/3 of the share capital. In one very particular case, which I won't develop here, they accepted a higher threshold, but usually it's around 60, maximum threshold 60, 65. In Germany, where it is permitted, well, you can read that by yourself. Second Second question, second point, if we are, again, the P2P, is there, at what threshold do I need to reach to delist the company? More precisely, to do withdrawal offer, followed by a squeeze-out. Again, the EU Takeover Directive indicates that the member states must implement a right of squeeze-out. They must implement it, and they fix a margin between 90 and 95, and leave it to the member states to decide to fix the threshold in this margin. So in France, the threshold is and remains under the new regulations 95%. And maybe I indicate to you here that yesterday, the new regulations of the French AMF, French Stock Exchange Watchdog, have been adopted and published. So it's, and I haven't had much time to review those new regulations, what we call le Règlement Général, which is a basic document regulating P2Ps, IPOs, etc. The new text has been adopted yesterday, and we needed a new text, as we need one in each of the countries represented here, because of the number of EU directives adopted pursuant to the Financial Services Action Plan. There are a number of directives which have been adopted over the last months, which must be transposed in national law, and because of that we have a new regulation, a new Règlement Général, which actually doesn't yet incorporate all of the new directives. Thresholds appear for the other countries. Maybe one word on the UK, where the situation is a bit more complicated than what could appear from the simple reading of this list. There is a very good London lawyer in this room, David Patient from Travers Smith. Maybe David, could you just comment in 1 minute? This is 90%, because I think it needs some explanation. As usual, the UK are much more flexible than the other countries.
Yes, in the UK, on most friendly takeover bids, the bidder will probably put in his offer that he will go unconditional at 90%. That is because in the second rung there, you've got the minority squeeze-out provision at 90%, which is actually not 90% of the company, but 90% of the shares to which the offer relates, and therefore doesn't include shares which the bidder may already own or control. What happens, though, on the acceptance condition is that regularly, although you might put 90%, you may actually waive down your acceptance condition to somewhere between 75 and 90%, because when you look at the shareholder list and who has not yet accepted the offer, you may find that there are shareholders there who haven't been able to accept the offer because of their constitution, pension funds, hedge funds, people like that, but who almost certainly will accept the offer once you go unconditional. You would probably not want to go unconditional too often at less than 75%, because you're going to need 75% approval in due course when you come to take the company private, so as to carry out your financial assistance whitewash, which allows the financing banks to take security over the target company's share assets. Thank you, David.
Next, I think that's I want comment on the tax consolidation thresholds, where you'll find by yourself the right advice when needed. This gives just an indication. A few words on the next one. The next one gives you an indication on how P2Ps are usually conducted in France. What you usually do is that you would buy a block. You would buy a block which would ideally represent more than 50% of the share capital and of the voting rights. That's usually what happens. So first you purchase the block at a price which can be negotiated freely. You are not bound by the stock price. And then the question, then you will be obliged, pursuant to French stock exchange rules, to launch what we call a guaranteed cour, a standing offer. The guaranteed cour, what it means is that during 10 trading days, again, I may simplify it a little bit, but just the main characteristics. During 10 trading days, you are obliged to purchase any share presented at the price at which you have purchased the block. It's a very clear rule which has the main advantage of avoiding a justification of the price. You use the price at which you have purchased the block. There can be exceptions, but let's not maybe now go into that detail, in particular if the seller of the block gives webs and warranties. But the principle is the one I indicated. But to be under that regime, you need to have purchased, you need to have acquired from one seller or several sellers acting in concert at least 50%. If you purchase 20, 25, and 10 from 3 different purchasers, which did not, therefore, together control the company prior to your purchase, you cannot use, I mean, the MEMF will decide that you do not use the standing offer regime, and you'll get into another regime, which is the regime of the simplified offer, which has the disadvantage of enabling competitive offers and also the disadvantage of putting you in a situation where you have to justify the price you offer to the market. That's the main difference. And one word on the last point, the dual price offer. What is the idea there? It is the idea is the following. It would be possible in a French P2P. It hasn't been done to my knowledge in France. It has been done in the UK, but not in France, to have a different, to propose an additional price, a bonus, if I may say, in case you acquire more than 95% of the voting rights and share capital of the company, to enhance, to encourage sellers to bring their shares to the offer. It would be, I think, an intelligent trend if you are afraid not to get to the 95%. And then from that, you could sophisticate. You could either give a bonus, or you could imagine, but we don't have the time now to get into that, but you could imagine to give a bond issued by the newco, the one, the acquirer, a bond which you could eventually list to give some liquidity to the seller, and which would be convertible into shares of newco at the time of you get out of your LBO investment. This would have the advantage of convincing some funds in particular who want to accompany you in the gain you'll do during the LBO to benefit of that advantage. I think it would be an interesting feature of which one could think in case of a P2P. I'm not sure I need to speak of the 2 other slides. One is on the calendar, and I think it's self-explanatory. You purchase the block. Well, first you sign the purchase agreement, then you have usually to get the EU antitrust approval. Then you close. After the close, you do the guaranteed cour. After the guaranteed cour, you'll do the offer, the withdrawal offer, and the squeeze out. That's described here. And on the last document, on the last slide, you have a brief list of what the offering documents have to contain. Thank you. Coming back to the real world.
Okay, on Vivarte. First of all, we as PI are having a certain experience, not expertise, experience of P2P, because apart Vivarte, we've done in the past United Biscuits in the UK, Michel Thierry in France, and very recently Psycho in Italy. As all these cases are very different because located in different countries, we can totally compare these different operations, and we can say that we are using the same knowledge and the same expertise across Europe. Concerning Vivarte, that's the perfect example of successful P2P, because of the fact that we have been able to reach to obtain more than 95% just after the simplified tender offer, and we have been able, as a consequence, to execute the squeeze out very quickly. So we have put in place that transaction under our initial agenda, and we have been very happy with that. I think that one of the major reasons for which we have been successful is because the company was having was of a limited interest for institutional investors because of the sector, because of the size, and nobody was really very interested by the story of Vivarte. It gives me the opportunity to say a few words about Grand Vision. You know that we launched an offer in July last year on Grand Vision. Grand Vision was a very well-known company, despite the limited size of the company. I think that one of the key reasons for that is the fact that Daniel Habitant and Michael Lickman are great communicators. Having said that, we have had to face a very strong competitor, which is the HAL Group. HAL is now the largest optical retailer in Europe. So we have had to face the competition of a strategic buyer. And to be frank, we have underestimated their ability to react and ability, in fact, to go against an offer which was totally supported by the two founders of the company. Having said that, HAL was looking at the transaction with the eyes of a strategic buyer, so with its ability to bring purchasing synergies and all that kind of things. Last word on that, we have also underestimated the fact that the presence of HAL as a small investor in the company with 8% was a clear message to everybody.
But Vivarte was more than twice bigger, so.
Yeah, but in Vivarte there was we bought since the beginning 68%. So the situation, the two cases are absolutely not comparable. And as Patron said, there are very good reasons for which there are not so many P2P transactions here in France. I think that Bertrand told you what are the good reasons for which there are a limited number of transactions. And we can't compare Vivarte with Grand Vision. Regarding Grand Vision, we started with a 30% stake, so we have had signed an agreement with the founders and some key shareholders representing 30% of the shares. In the case of Vivarte, we started with 68%, which is a totally different story. So you have to look at each situation for its own benefits, and I think it's impossible to draw general rules from very specific and very different cases, which is absolutely not the case in the UK, where you are having a market which is totally developed with rules fully understood by everybody and with good acceptance by institutional investors of such transaction. I have a last comment to make, which is about the 95% threshold. It complexifies the financing. It affects the financing. That's not the major point from my point of view. That's not the major issue, because we PI, when we are looking at the P2P, we are looking at the P2P on the basis of a scenario where we are not getting more than 95% of the shares. So we are not taking into account the option, which is to have the tax, to put in place the tax consolidation. The key problem from my point of view is the fact that some people are knowing well that you are interested in the fact to obtain more than 95%, and some guys are specialized in the fact that to own more than 5%, and you have to deal with that issue. And I can confess the fact that in the UK, I think that you don't have to face that kind of situation. You have to discuss with large institutional shareholders. These guys are very tough on the price they are willing to obtain from you, but they are very professional. They are making arbitrage between liquidity and price. And if your price is insufficient, they will tell you, and you have to negotiate, you have to obtain their agreement. As soon as you have their agreement on the price, you can execute a transaction without having to discover that some guys are above 5%. etc., etc. So the 95% threshold is still a major hurdle to the increase in the number of transactions in France.
So do you think 90% would be a good number or lower?
I think that we have to take all the... If we want to develop that market in France, we have to look at what is done in the UK, and I'm sorry, we have to try to replicate the rules which are in place in the UK. The UK market is very developed. That type of transaction is very normal, which means that there are a huge number of rules which have been developed to deal with that kind of situation. We have to take into account that fact. We have to learn from what has been done and put in place.
Thank you very much. Bertrand, on the Provimi case?
Yeah, on Provimi, very quickly. Here again, this is a case on its own. I mean, Provimi is one of the world leader in the animal feed business, making a turnover of 1.5 billion euro and present in 28 countries. Actually, when we look at Provimi, it was together with PI. Actually, I have to say again, it was quoted on the French stock market. Funny enough, it is still quoted on the same market, and I will tell you why. Basically, when we look at the deal, the company was owned at 54% by Montedison or Edison, and as Daniel was saying before, we basically negotiated with Edison a price for their 54%. The interesting thing was that basically when we were making our negotiation, the company was quoted at an average price of 20 euro, which in our mind and in PI's mind was certainly speculative. And basically we announced a price in August of 14.5 euro per shares, which obviously, as you can see in the chart on the screen, came as a shock for the shareholders. But at the end of the day, we were just applying the law. We were discussing and negotiating in good faith with a willing seller. We came to a price, and this price was basically the price which was proposed to the market. Actually, it wasn't absolutely true, because what happened during the summer was that the current trading was not that good, and I remember that it was not a very good summer for us. But basically, we came back to Edison at the end and said, by the way, we have a little problem because current trading is lower than what we initially anticipated. And so basically, we started the negotiation again. And so we had a very interesting discussion with our lawyer at the time, and Daniel was our lawyer. And basically, the final price was 13.25 euro per shares. And here again, the same principle applied. Basically, we had cut a deal with the majority shareholder, and we proposed the same deal to the minority shareholders. And we didn't have any complaint whatsoever from the minority shareholders, because there was no ground for that. We were just applying the law. I think the other point I would like to make is Provimi is not really a P2P. It is a P2P, but it's a public-to-public, because the company is still quoted. The reason for that was that there was all the debt was at the level of the operating company. So as Michel was mentioning before, it wasn't necessary for us to get tax consolidation, because obviously the interests of the debt were offsetting themselves against the EBIT of the target company. And all of that went into the right direction, because obviously the price we were proposing was not extremely attractive, as you can imagine, for the shareholders. But it was not in our interest to get more than 95% of the share. And basically, in spite of this price, which was considered at the time to be relatively low, we went from 54% to 74%, and that's still our stake in the company. We didn't need to go above that. And since then, the company is trading relatively well. It is trading at 16 euro today.
Now to IPOs, Emmanuel.
Yeah. I mean, once Michel and Bertrand are successful in doing the P2P, there are three potential exits after a few years, as you know. Either a strategic buyer, a secondary buyout, and the third one is the public market route here, the IPO.
I thought it didn't exist anymore.
So on the IPO market, just quickly, what happened over the last 2 years? Because up and until last year, be it in Europe or in France, the IPO market was quasi-closed in terms of both volume, number of transactions, and the few transactions which got priced in 2003 were not trading particularly well. And in France, as a matter of fact, there was no transaction at all. 2004 has seen, and I think it's a very positive sign, a reopening of that market. Deals get done. I'm not saying that they are trading particularly well in the aftermarket. It's been a very patchy and mixed aftermarket performance, and we can come back on that. But at least the market is reopened, has reopened, and investors are back ready to put money to work into IPOs. And I think it's a very positive sign. Who are the sellers? Next page. Mainly what you'll see that coming from financial sponsors, if you look at the whole IPO market in Europe, a quarter of the volume comes from financial sponsor. This is very significant. If you get back to 98, 01 until the bubble exploded, most of the IPOs were coming from corporate or were startups, but the percentage coming from financial sponsors was closer to 10%. We are now at a quarter of the volume, and I will plan that volume coming from financial sponsors to increase over the next 2 to 3 years, because there's been so many acquisitions done over the last 3 years by the friend on my right that normally by construction the IPO coming from that source should increase. Now, as you can see, there is a bias as well, the lot coming from the state, and this is in particular the French state in terms of volume. You have all the jumbo IPOs such as EDF, GDF and so on, which are going to be 5–10 billion piece, which even if they are in a very different category from the one coming from financial sponsors, nevertheless will set the tone in terms of receptiveness, attractiveness, and capacity to place paper. And the whole market will look at this big jumbo elephant in details. The latest one got priced yesterday was the motorway CEFI-2004-T2-10h30 sold by the French state, which got successfully priced and is trading right now. So watch that space as well, because that one will have repercussions and implications on the rest of the market. If we skip directly to page 5 in the interest of time, we've tried to summarize what's the key perception for an investor when he sees an IPO coming from a financial sponsor as opposed to one coming from the founder or a corporate if it's a sub-IPO or the state, as we mentioned. I think there are 4 or 5 key points that the investor will immediately ask himself questions about and ask to the banker and to the management. Number one, the stuff he's going to look at, obviously, is the capital structure. Is the level of leverage, including whatever amount of primary is done at the IPO, is the level of leverage sustainable? Obviously, as it comes from a financial sponsor, there's been an LBO, there's been a maximum leverage. Is it bearable from a market point of view? Because as an investor in the equity public market, I'm ready to invest in a story. I'm not ready to invest into a credit story. I'm not ready to invest in whatever kind of risk there is on the balance sheet. So he would like to make sure that from a capital structure point of view, things are in order and comparable to where the others are. And if they are not, which might happen very often, if they are 1 or 2 notches below in terms of rating, that there is a good certainty or a good level of comfort that within 1 or 2 years you can get back to a normalized number and that there is no credit risk attached to my investment. The second one, which I think is more complex to address, is that there's always a perception when a financial sponsor does an IPO that all the juice has gone, if I may use that expression. That all the cost structure reduction, rationalization, restructuring, and so on has gone through, and what's left for me as an institutional investor getting into the equity. So that's something to look at. Are there any more cost synergies, any more cost restructuring, or is it just a top-line growth story, and where did it come from? Second area. And it gets into the growth, because that's part of the answer usually, that there's still some growth. And the debate right now in the public market is that we've seen a lot of investors interested in what I call cash and dividend yield story. In a low growth, low rate environment, people want to have a cash return, and that's going to be the main theme over the course of next year. And the main debate remains, is there's going to be people ready to pay for growth in the course of next year? And how do you demonstrate growth? How can you qualify it? And what kind of credit the market is ready to give you for that? Then the management, the expansion opportunities and the management continuity, I would say, are secondary factor. The last one, which is important to bear in mind, is when an IPO comes from a financial sponsor, there's always a sentiment from the institutional equity investor that he's going to try to extract the latest dime. which is perfectly fine. Okay, I mean, he's working for people to get the highest IR, so he's going to say what's left for me as well from a pricing point of view. So he will always look at the IPO pricing coming from a financial sponsor as something usually more tight and a lot more squeezed than you would have in a normal IPO coming from a corporate or from the state. And that's what you can see in a way in the bottom chart, where we've tried to illustrate what has been the aftermarket performance of IPOs, depending if they were coming from financial sponsors versus IPOs coming from the rest of the crowd. And usually, on average, over the last 2 years, it is true that the financial sponsor IPO have been better priced in a way, because there was a lower aftermarket performance, a better price from a seller point of view, maybe a bit less return for the institutional investor. So that's another perception that has to be taken into account whenever a financial sponsor does an IPO. Now switching to page 7, quickly, what are the value metrics today which are used by the market in an IPO? I'm not going to go through all of them, you know them. These are all the metrics which are used in the current market to value an IPO. What we've tried to highlight is that depending on the type of investors, people are looking at different way of valuing a company. That's the first point. Okay? Be it if you are a hedge fund, or if you are a value fund, or if you're a growth fund, or if you're a domestic fund, you're not going to look at the business model the same way, and you're not going to value it the same way. First point. Second point is that there is also what I call the market fad. As we said right now, compared to last year, people are looking for cash return. They are looking for free cash flow yield, i.e. the total amount of levered cash flow which is available to both debt and equity holders, which is available, and what kind of percentage. And how much of that is going to get into my pocket as an equity holder as dividend yield. That's the reason why most of the successful IPOs this year have come from predictable cash flow, visible cash flow model. Aircom, Belgacom in the fixed line, Pajot in the yellow directory done before June. And that's independent from the seller in a way. And I think that should be a theme which should play and help whatever IPOs is coming from the financial sponsor universe, because obviously, by construction, usually they are very regular, very visible, very predictable cash flow. If I switch now to page 9, directly, who's buying IPOs in the current market? We've highlighted the various sources. I mean, the main one is in this big circle on the right-hand side, are the global institutions and the hedge funds. What we've seen over the course of this year is that there is an increasing tendency of having what I call global institutions are the people like Fidelity, Capital, you can put even an AXA Asset Management into it, Merrill Lynch Asset Management, people who have resources on a global basis and who are doing portfolio allocation on a global basis. Number one. Number two, the hedge funds. And I'll say just a word on the hedge funds because they've been increasingly important over the last 3 years, as you know. They've been playing now a role in terms of allocation in deals, and that coming from the whole market, which used to be around 10 to 15% of an IPO, now something like 25 up to 40% of an IPO can be allocated to hedge fund. Now, a small word on hedge funds. In hedge funds, semantically, it's a word which covers a variety of people. You have the guy who just do a back and flip, back and forth trade the following day just to make a quick return and just enjoy the IPO discount. But you have a bunch of people who are extremely serious, as you know, who are getting as well into the private equity universe in terms of IR, and who are spending a lot of time to know the story and to invest from a value point of view over 12, 18, 24 months. And I can foresee over the next 12 to 24 months a lot of conversions between hedge funds and private equity buyers here, and having them playing an increasingly important role in IPOs. French large institutions we can replace here for any kind of domestic institutions in a way, but in particularly in France, are playing a lower and lower role. And the reason being, I mean, there are various reasons, but I mean, I can give you an example on the Pajot IPO, the demand coming from French investors was half of what we were expecting, half of what my French colleagues, bankers, who were working with us on this were expecting as well. Same on plenty of other IPOs or even secondary placement we've done. We've sold for the French state 5 billion of France Telecom. This is a secondary in September. Less than 10% was sold into French hands. One US order was bigger than the entire French demand. one US order was bigger than the entire French demand for a France Telecom stock, which is extremely well-known, liquid, and so on. And you have the same for small and mid-cap. The reasons being that French institutions are mainly benchmarked against the CAC 40. They can't afford to get into new deals and have a standard deviation from the index, plus the fact as well that they used to be overrepresented in the past because they were tax advantage with the PEA. And once the PEA has been opened outside of just French stocks, they are coming back to what is their normal level, which is just proportionate to how much assets it's managed within France versus other countries. Now, just to finish it, so I think the key theme for next year, cash return, free cash flow, hedge funds becoming more active, foreign demand being important, and domestic demand being less and less crucial to place any kind of primary deals, being capital increase, IPOs, blocks, or whatever. The last part I finish on page 11 very quickly is the market in asset management has enjoyed a vast concentration and consolidation as well over the last 2 to 3 years. Okay, there are less and less, there is a lower number of funds playing deals here, which means that the concentration in IPOs we are pricing, and here we've put IPO that Morgan Stanley led managed during the course of this year, Belgacom, Pajone, Postbank, Telecinco, Virgin Mobile, so you have a good cross-country here, but the concentration is extremely high. With the top 50 investors, you have close to between 60 and 80% of the total deal size. And within this top 50, guess what? There are between 10 and 15 people who are making everything, who are making the price, who are really the price, who are making the analysis, and the rest are followers. So it's a more and more concentrated market, smaller number of actors, and increasingly sophisticated.
Thank you. And now the legal side, Danielle, of IPOs.
Okay, that should be an easy one, because for P2P, we said P2Ps are hindered by legal constraints, mainly. That's not true for IPOs. There are no legal features which would restrict IPOs. It's now a fairly well-known, obviously, process, which has been, I must say, recently, again, the rules have been relaxed in France. On various items. Probably the pro-stock exchange lobby must be quite efficient in France, because P2P's rules are not relaxed, but those are. What could I say here? That in France the preparatory work would take from a minimum of 4 months to approximately 6 months. That it is extremely demanding, that the management can only with much difficulty both prepare a successful IPO and manage the company. And that should be well anticipated, and it's probably particularly true for a company which went through, for a corporate which went through an LBO. I was to describe to you some new legal features, but that would really, it's quite technical and would really take us too much time to do it now, and would maybe. So what I would just say on this first slide is that there is now an easy mean under French law to propose shares within an IPO at a better price than the public price to, I would call them, partners of a company. Example. If I would say, in Général de Santé, maybe that you know, which owns hospitals, shares have been offered to physicians who are neither employees nor the general public, and have been offered to the physicians, particular partners of the company want to propose them a better offer than the one made to institutions or to the public. There were means, rather complicated means to do it. There is now, since June of this year, a simplified mean to achieve that. Must keep it in mind. It is quite interesting. It enables you to propose them a better price. And when people, even if whether a price is deemed expensive or not, when they see they have a better price, they are always attracted, particularly in France. A second feature is what we call the guarantee de bonne fin. Again, a rather technical one. Up to now, the underwriters had, in case of a capital increase, And there is usually, even when we're speaking of an IPO for an LBO company, we're speaking of funds which want to exit, obviously. But even when they want to exit, usually the company needs to restructure its financing, and therefore there is a share capital increase. Good. For that share capital increase, up to now, because of particular features of French law, the underwriters had to grant what we call a garantie de bonne fin, which was an irrevocable commitment that any share not subscribed by third parties would be subscribed by the bank. That's, in theory at least, now no more indispensable. And that's again good news. It gives more flexibility, and maybe it could have an impact on the bank's remuneration, but that's not my issue. The documents for public offering, what you just need to know there is that in November 2003, a new prospectus directive has been adopted, has to be transposed into national laws by July 1st, 2005. So any IPO on which work begins now will probably be regulated by that, should be regulated by that new text. It is extremely interesting because it makes life simpler. It makes life simpler because if you do a transnational offer, a cross-border offer, it enables you to get just one authorization from the home member state authority and to go with that. That's like a passport. You can go to do your offer anywhere else. It also defines for the first time community-wide what a private placement is. That was not the case in the past. So it is a real advantage, and it should decrease, it will decrease the costs, at least for cross-border IBOs. That's where it is interesting.
Just a couple of market comments from Bertrand about a recent IPO, Alfred.
Yeah, I think unfortunately we haven't done any IPOs in France. I mean, for the last one was Entrelec in '97. So it's not again. I mean, for us a very active market. The latest example we've got in CVC is Halford. Halford is one of the biggest retailer of automotive and bicycle accessories. And it was introduced to the English stock market in March last year. It was quite a successful IPO. 45% of the shares were put on the market, and this deal, together with the leverage recap, which was done a couple of months before that, has enabled CVC's funds to make 3.8 times our money. But I think what is important again about the easiness of the UK market is the management are much more used to that. And what we've done in the case of Halford is very early in the deal is to strengthen management. We have recruited a new CFO who used to be in a public company. We have also changed the CEO of the company. So I think this was absolutely key in the success of this IPO. You've got some numbers in the slides back if you want.
I'll pick up on one of the points of Bertrand, which is on the management continuity. It's interesting the point he mentioned on Halford, where the management has to be changed for the public company, and that's a debate which is an interesting one, because clearly investors will always try to look at people who've got the experience of the company and who've been through it. But on the other hand, these people who've been over there for 10 years, 15 years time or more may not be the best capable people to present the company to the market and to bring the company to a new stage. So there is this ambivalence between getting people who really know well the company, who've been through it, who know it in and out, and people who know a new set of shareholders who are going to be the public market and who've been used to and who've been through IPOs in the past. And it is true that on average, when you look at previous examples, it's important to try to have a mix. That would be the best thing. You usually have the CEO who's been there for a long time. You have a CFO who's been through a public company, but it's not always possible. So that's just one remark I would make. The second one I would make as well, in terms of when you get out, and it's again Bertrand remarks on the 45% exit they made on Halford. There was a question at some point of time: is there market capacity to get out entirely? I've done my P2P. I'm 100% owner of the company. I want to get rid entirely. I want to do just a 100% secondary or mix of secondary and primary IPO. And how is this going to be received by the market? And I think here there is an interesting distinction between the European market and the US market. In the US market, such a structure will not really fly. Because investors would immediately say, okay, they're just getting away entirely. They're not going to be exposed anymore how can they pretend this is a good investment opportunity? The main fact that they're not staying means that it's not that good, and they're getting away. It's a very simplistic way of looking at things, but it could have some credit in the minds of people. In Europe, there's been examples, very few of them, but there's been examples, and I think it relates more. There is not the same perception about if I get entirely out, because I think investors are used to the fact that the financial sponsor has duty in terms of time horizon, closing funds vis-à-vis another set of shareholders. It's more a question of market capacity. And clearly, in the current market capacity is not an issue. There's plenty of liquidity, so there's ability to absorb large amount, and it could be above 50%, 60%, 70%. We have flexibility now in France, as we have in other jurisdictions, to start with a small size and to increase it pretty drastically. But the key stuff is there a price volume sensitivity and playing the right side of the curve, which right now there is a very small elasticity between price and volume, so you could do large volume in the current market. Throughout, I'm not talking just about France, and this is throughout Europe, because as you've noticed, all these IPOs between Spain, Italy, France, UK, and so on, the top 50 investors I was talking about are more or less the same from one country to another one.
It's a question for Bertrand, really. My name's Robert Barnes from Alchemy Partners in London. We've done 20 take privates in the UK and one in Ireland. You made one comment about the difficulty of doing due diligence. Now, quite apart from all the legal issues in France and, dare I say, other parts of Europe, do you have any particular comments to add about this due diligence barrier to getting into being able to do public to privates in France or other parts of Europe?
Yes, I think it depends. If there is a public process, as it was the case with Provimi, it was. I mean, we didn't have a lot of difficulties in terms of due diligence because everybody knows about the process. There was a vendor due diligence and so on and so forth. But most of the time, when we try to preempt deal which is public, it's extremely difficult to work only out of public information. And as you know, and I'm not an expert there, but maybe Daniel could help me on that. But you're not allowed in France. I mean, if to provide specific information which are not public to only one party, which obviously, if you want to preempt a deal, makes everything fall apart. So I think this is the main difficulty. Am I right in saying that? So I think this was my point. I mean, however, there is a deal which is very public at the moment, which is, for instance, Rexel. In the case of Rexel, the VDD has been put together by some people present in this room, by the way, and so the information is of good quality. So I think this point was, I think, much more true a couple of years ago. It is getting more and more professionalized because of the presence of vendor due diligence and so on and so forth.
Sorry, a second question actually came up. Throughout listening, there's been not one comment about banking arrangements and security in public to privates. I was just wondering whether, again, from a European perspective, you can give your views on, how much of a barrier is that to the activity, as opposed to other features that clearly are barriers in the French market.
I think it has. I think I'm not sure I'm the right person to answer this, but I think your question has been addressed at least earlier. Yes, it is obviously a barrier. It is a barrier depending. It wasn't in Provimi case, for example, by definition, because the financing was at the level of the target. If you have to implement,
the excess borrowing was at the level.
Sorry,
the excess borrowing, not the financing.
Oh, excess borrowing. Well, but excess borrowing. Yes, it is obviously a question. But then that's why you would have done, for example, a capital increase, which has next to the secondary. That's precisely the purpose, and which. So yeah, that's the reason why there is a secondary. But I think that really can address the excess borrowing and addresses the refinancing fairly easily. And then, with respect to the finance borrowing, still I would like to come back to that one. There are a number of, if you do not get if you do not reach 95%, if you cannot delist, there are a number of features obviously available here, which are not easy. which are dividends. You use special dividends if you have distributable reserves. That's something which is often used, which raises legal questions, but which is a feature which enables you to push, to economically at least push down the debt.